Good morning, everybody. Travis Smith here,
Hey y'all, it's Liz Rich.
and we are here to talk about interest rates, macroeconomics for the first few minutes, and then we're going to get in and do a deep dive, the first of our deep dives on first-time home buyers. And Liz and I are both excited about this. We are former educators. This is our passion right here. So here we go. Today, Liz, this
Good meeting.
afternoon, our boy J Pal coming out.
Let's go 130.
Yes, 130, and the market's essentially holding its breath right now. You don't see a lot of action. We've drifted back to the top of our range at 4.3. I think we're at the 10-year. I think the 10-year
Yep.
might be a little bit less than that right now, but we're kind of at the top of that. I'm not expecting a raise,
Me either.
and I'm definitely not expecting a cut. What about you?
Yeah, same. I think we're gonna just hold steady right now. I don't think there's any new information that's going to allow a cut. I would be shocked. But
Yes.
I don't think we're gonna see a raise either. That would, to me, be more shocking than a cut.
Yeah, either one of those would be kind of unannounced, and the Fed does really like to try and prep the market for what's coming. So the moves aren't huge. There's not a lot of volatility they add, or any more than they already do. But to kind of bring out and illustrate that point, you were able to send over a slide for the Fed dot plot. Can you explain to that what this is?
So each year the feds come up and they individually vote on what they think rates are going to do, and so then they also look at it from a year over year moving forward, what could potentially be happening. So the 19 Fed members, they have voted, and if you look, it tells you to the right hand side how many cuts they think they're going to make versus where each individual person lines up. So then moving forward, it shows you the trend of what we think is going to happen over the next 2 years. So you can see in 2024, we're looking at some rate cuts where the most of them said maybe 4.5, right? That was where you see on that dot plot, the most Fed members thought we could see rates cut. Well, we all know that they came out and said 3 rate cuts is what they're anticipating seeing, but we have some people in the reserve saying could be more. So now if you look to 2025 and 2026, you see the trend of the arrow going down, meaning they are anticipating over the next 2 years rates continuing to drop. So that is all good news for buyers, especially if you're looking at getting in now and building that equity, because we know every time rates drop, how many more buyers enter the market, which the number one thing for prices, why I'm not anticipating seeing like a 2005, 6, 7, 8 over again, is simple supply and demand. There is still more demand than supply. So
by a lot too.
Yeah, we're going to see rates drop, but we're going to see home prices go up. So it's, in my opinion, get in before the price, it costs you more.
Yep, especially because if you do a government loan, FHA, VA, you can do the streamline refi a couple of years from now. And man, if you could knock your interest rate down 2 full percentage points, that's hundreds of dollars a month.
Or as the other thing, I was talking with a first-time home buyer yesterday, like long-term game is he's closing tomorrow. So he's already a step ahead, but really looking at dropping the rate. But as prices increase, we might be able to refinance him out of that mortgage insurance too. So not only do you need to look at it from, can I get out of the mortgage insurance? Can I also drop my rate? So maybe that rule of thumb of only refinancing if I can get my rate down 1 full point might not apply to some first-time buyers if they can refi for a 0.5 point, but drop the mortgage insurance.
Yeah, the mortgage insurance is huge.
Yeah, that's why you gotta love UWM and their discounted mortgage insurance.
Yes, that is so crucial because it's hundreds of dollars that just go into the vapor. Like
Yeah.
everybody understands principal. We pay the interest because that's the cost of getting the money loaned to us. However, we feel about taxes, at least the taxes go ostensibly to
Yeah.
schools, local projects, things like that. And then even our insurance, which, gosh, home insurance recently has been a battle for a lot of people.
It's
Um,
finally starting to level out too.
yes. Well,
So
and those actually are tied to interest rates as well. I don't think people understand that insurance companies are sensitive to interest rates also because of how they operate their money and whatnot. So, but you understand where all those things go. The mortgage insurance, that's just money that evaporates, right? Like that doesn't actually do you any benefit.
yeah.
It's really there for the whoever holds the note at that point in time.
Yeah, it's to listen. It's essentially a risk management factor. The
Yep.
better the credit score, the lower the risk factor is because you have a better history of paying. It's all that going back to the ability to repay, but also make sure the banking system is doing some CYA there too.
Exactly. Which, to be fair, is a good thing. We don't want another 2005 through 2008.
No.
Everything's a party. Everybody's getting approved. Like, as much as we would love to sell that many houses and write that many mortgages, like, I think we all
What's best for
saw.
the consumer, right?
Yeah, and exactly. I think we all saw how that worked out. It devastated the economy, and the people who did buy going up into that, a lot of them lost their houses. A lot of them were buying on arms. Thankfully, we still don't see a lot of those, even with the higher rates. This dot plot I find interesting in the sense that I'm curious what their impetus is to cut rates. Do they think that a recession is coming or that jobs are going to start doing worse? Or are they just thinking that we want to get the rate down to a certain level? Is there like a target that they have in their mind that they're really going for? Because if there's not, and we continue on this track of, let's say inflation does tame out, but it stabilizes right at about 2%, which is their target, and
Right.
we still see jobs stay fine, why do they cut rates?
Yeah. I mean, that's a great question. My gut instinct is to help the first time home buyer. If they're going to cut rates, it's to build generational wealth and help more people get into homes.
Well, and the other thing I think they might be looking at is the cost to finance the US government's debt.
Yeah.
The higher that rate is, the higher the interest payments are, and the more it takes up the budget. So by lowering the rates, it'll help out the Treasury Department and everything else, which again ostensibly helps all of us out because there's less federal debt. Because the federal debt is something that's been ignored for a long
Since
time.
Bill Clinton, I'm pretty sure he was the last president that
Yeah.
had a balanced budget.
And every
no
president since
politics there, but I
then,
mean, that's facts.
every president since then, Republican or Democrat, has continuously blown the budgets out. They don't have budgets, so we just continually have these debt increases, and the chart literally is going parabolic. But at least it's become a conversation again. The Federal Reserve has essentially told the federal government, "Hey, y'all are going to have to do something about this." And Yellen, in theory, should understand that, having been a former president of the Fed herself. So.
Yep. That
Watched
we could talk about all day too.
watched an interesting interview with her a couple days ago, and she admitted that that inflation was not transitory this time around. I was like, good call, Janet. Like
I mean, you got to watch her budget too, because like she's tied to the money markets, and when rates were going up, people moved out of the CDs and into the money markets because those money markets are on that variable rate, right? And so they locked in at the highest that they could, and now Janet's piggy bank is starting to dwindle, and that's that whole reverse repo situation. So my prediction is if Jay Powell does not ease off this quantitative tightening and she runs out of money, you're going to see rates increase and nobody's going to understand why. But that, in a nutshell, that's what would happen.
Well, maybe that's why we see them dot plotting downwards, is because that would create issues with liquidity. And that's something that would cause them to cut rates, right?
Right.
Is if we start seeing issues with liquidity in the banks and whatnot, then the Fed will step in and immediately start to cut rates, hopefully not turn QE back on. But that's definitely something that would cause them to act.
Right. For sure. I agree with that.
So y'all make sure, watch Jay Powell today, but more importantly, watch the interview afterwards where he talks about the words when he does these interviews, just like the Fed President's Forum, he is very careful with every word he uses. Every word he uses, there is intent with what he says. And then they'll also, I believe, release an updated dot plot for us that we can check out and kind of see what they're looking at for the rest of the year. But today's an interesting afternoon, and it'll be, I think, the last one for this month, because we don't have to worry about it until April's employment and inflation numbers come out, because nothing else has really been moving the interest rates except those two things. So
you'll have another beige book between now and employment and the
the beige book is really good too. I mean, it's a really fascinating read if you like to nerd out. But that doesn't usually move rates too much unless they say something in there that catches people off guard, I think.
Yeah, unless there's like a negative remark. But yeah, definitely Jay Powell's interview at the end of the meeting, that's your key. Whatever his comments are, you can bet that's going to move the market one way or another.
Yep.
But everything's positive right now, and I'm still looking at MBS Highway, and we're still up today. So there's no indicator that rates are going to be really dramatically changing at this point in the day.
No, I think we stay in this range that we've been in for the last few months. Hopefully, because stable rates are good rates, right?
Right.
So, and especially for first-time home buyers, which we'll go ahead and segue into.
Yeah.
Like we said, yes, we love first-time home buyers. As former educators, Liz has helped out a ton of them. I've worked with quite a few of them myself. There is the most not social, but just regular anxiety with them. So when you're working with first-time home buyers, as you know, it's not just as an agent or as a lender. You're their therapist. You're there to listen. You're there to help guide them, because having been a first-time home buyer, I would say recently, and then I realized it's actually 9 years ago.
Wow!
But I know
a decade of home ownership. Congratulations.
Yes, and it's been a huge part of why I've been able to accomplish what I have been, and why. For anybody who is renting, if you can get on the home ownership ladder, it's always worth it. It's always the right time to own instead of buy. Even if it doesn't look like it might be for the next 3 months, the next 6 months, housing isn't a short-term idea. It's not a short-term investment. It's something that needs to be looked at from a span of 5 to 7 years. And what you would, how that looks for you 5 to 7 years out.
Well, and I think we live in this culture where social media tells us we can become rich fast. But then you take a look at the old school millionaires, and I don't really agree with everything Dave Ramsey says, but there's a lot that he says that is true, where if you just get in and you start and you let it grow slowly, because real estate is a slow game.
It is.
I think that's great advice, but he does have some things that I completely disagree with. But I think his idea of having low debt to buy a house and manage your money wisely and use your income as your greatest wealth building tool, I think that's great advice. Like, don't spend more than you make.
The best thing that you can do at any point, wherever you are in your economic life, if you haven't already started, is to pay yourself. And by paying yourself, that means paying down debt and putting money into savings, those two things, because you want to be as debt free as possible, just in general. It's better for your mental health, it's better for your financial health. And kind of on that subject, I posted a graph that credit card debt has crossed over $1.1 trillion. It's over $1 trillion for the first time, and it's rising really rapidly, which people assume that people are starting to pay bills with credit cards. And that is a bad sign. Hope that's not the case, especially because credit card rates right now are astronomical.
Right. We balk at a 7% homeowner interest rate, but we're willing to pay 23 to 29% on a credit card.
Yes.
Which,
and a legit 29% too. I mean, it is rowdy on there. But so for our first time home buyer, Liz, what is the very first step that they should do? They're thinking, all right, this is the time. I've been cruising around on Zillow or Realtor.com or whatever, Trulia, whatever their site is. Let's be honest, it's generally Zillow.
right.
And they're starting to think, okay, I want to buy a house. Who do I talk to first?
Well, I mean, I think the first thing is you need a trusted mortgage professional, whether you're talking to a broker or a retail lender or a bank. You need somebody that you can be vulnerable with, because at the end of the day, exposing your financial situation is very vulnerable, and it makes people, I think that vulnerability leads to fear, and that fear is a blocker of why people just don't even get started. So you need to find somebody that you can trust and be honest with and lay out your situation. And then based upon that initial consultation, that lender is going to give you some guidance on, are you ready, or do we need to put a plan in place? And if you're talking to a good lender, they're going to help you map out a plan, because we both know there's people who come to us that want advice, that think now is the time, but they're just simply not in a position. So if you can define clear steps to accomplish that, then you're in a much better place. So just some simple rule of thumbs, like the best advice I could give just for a general, maybe somebody who hasn't met a lender yet or is in a place of fear, not, where they can reach out yet. So it's just some good advice. Like, don't make any major purchases, right? Like, don't go finance a car. Don't go buy furniture. You don't need the jewelry, right? Like, let's not do any big vacations on credit cards. Like, let's halt the spending and not make any big purchases. The second thing I would say is, like, don't quit your job, right? Like, I've seen an influx of people going from W-2 employment to 1099, and they're doing it because, I'm going to make more money, but really they have variable income, and now you're in a guideline mess, like going private money to make that deal work. But don't change your job. Or if you're really wanting to change your job, have a mortgage professional give you some guidance on what that's going to do if you're not a homeowner, right? So,
well, that, and I think some of that comes down to if you stay in the same industry, and there's other things like that. If you continue on as a W-2 employee, you're spot on, because it is extremely vulnerable. A lender during the process is going to see all your bank statements. They're going to need to see all your assets, all your debts, down to everything.
The penny.
Yes. And that's why I'm so comfortable referring people to you, for example, is because when you talk to these people, and we've worked on with clients before, you make them feel more comfortable with it, because it is a huge deal. Those of us who are in real estate, we get lost in we're doing all these deals. We get lost in the fact that, especially for first-time home buyers, it's a huge deal. There's so many things they don't know. Yeah. And like you said, it's much more than a specific company or anything else. Find a human that you will be working with that will partner with you. And even if you're not ready, any good lender, like you said, will work out a plan, because they can say, okay, within 6 months, you can do X, Y, and Z, and we'll be able to get your score up to around here. And this is what you can qualify for, and you follow through that. You go back to the lender, and obviously the lender wants to help you because we all want deals, right? But
Right.
we want to help people, and it's a win-win for everybody involved. It helps the buyer get ready, and then it also, brings in business.
Well, and I think there's also another confusion too, Travis, like the different avenues of lending. As a broker, I can do a lot more than I was able to do on my previous channel. So I think the information needs to be out there. Like, just because you don't get the answer you want doesn't mean that there's not another style of lending out there that can't help you, right? So
Yeah.
I think there's some, oh no, you can't do that. Well, really, there's a lot of things you can do. So I think you gotta be looking for different avenues. If you don't like the first advice that you get, be willing to put yourself out there to get a second opinion, because chances are there's a way to make the deal work.
Yes. There are so many different programs these days that people can offer.
How many there's out there.
Yeah. So somebody can help somebody. So after they talk to their lender, and that's what, to be clear, whenever there are people who reach out to the real estate agent first, right? That's the person they know in real estate. I have a lot of people who reach out to me and they're like, what's our first step? And my first step, or what I tell them, is exactly what you just said. Let's talk to a lender. Let's see where you're at, because you want to get to that pre-approval point before you're actually going to look at houses. And a lender can get you a pre-approval. How fast can you get one, Liz?
Less than a day.
Exactly. So it's not like you have to put your life on hold and wait. You get your pre-approval, assuming that you're eligible for it. And that tells you a general idea of how much house you can afford. Now, as we know, different areas have different tax rates. If there's MUDs, all sorts of things go into, can you afford the top of that price range or not? Generally, I think we would both advise not to shop right at the top of the price range, but that is what a lot of people tend to like to do, And so, I mean, it's their house, it's what they want to do. That's what we do for them.
Right.
But yeah, so
make sure you have a nest egg if you're doing that, right?
Yes, because it doesn't do anybody any favors if you're house poor, then you're going to be miserable. You're going to be upset at us. You're going to be upset in general. And it's not an easy way to get out of. You can't just turn around and sell a house 2 months later and
not lose your butt on it.
Yeah, and not lose your butt on closing costs, So the next thing, is to get the pre-approval, which they talk to you about.
Right. But I mean, just a few other things that I think a first-time home buyer might not know is a shoebox full of money, Travis, is not how we keep our money to be able to buy a house.
What about under a mattress?
I mean, to each their own, but that's got to be in a bank and it needs to be seasoned 60 days. So any large deposits over 1% of a loan amount. So think about that. You're buying a $300,000 house, which you still can do in Austin. $350 is doable. If you have a $3,000 purchase price, but you have a $4,000 deposit, the government's going to want to know from an underwriting standpoint where'd that money come from. And if you can't source it because it's shoebox money, that money's backed out and you can't use it for verified cash to close. So making sure you have your money in a verified place is huge.
Yes.
And so
because
the other thing, here's something crazy, Travis, that so you get a client, they're shopping lenders. Now you pull their credit report and you see that they have 3 or 4 different lenders pulling hard pulls. You're not getting approved eligible by Fannie Mae right now on those files. They do not want you to have a ton of credit pulls. So if you're in this place of shopping lenders, please, please, please have them do soft pulls until you're ready. 3, 4, 5 hard pulls from different lenders, you're not going to get an approved eligible. And that is our back end automated underwriting system. That's what we go off of unless we're doing a manual underwrite. So
that's a really good point, because there is the thought that if you're just doing loans of one type, like when you shop for an auto loan, you go in to buy a car and they send it out to all the different lenders who do the pulls. They essentially wrap that up into one pull, but that's not necessarily the case when it comes to buying a house. If you're actually doing the hard pulls with, like you said, 4 or 5 different lenders.
Yeah, it's bad. Don't do that. Or if you're going to do that, do it with a soft pull. Every lender can do a soft pull. That's what you do. And then I always say, get into the opt me out. That way you're not inundated with trigger leads, getting tons of phone calls each day.
That way your call log doesn't look like ours.
No. You need to opt into that, Travis.
It's the craziest thing.
Well, and speaking of, while we're on the topic of credit reports, a lot of times you get a first-time buyer that comes to you and says, I'm getting my tax return. I'm going to pay off some debt and I want to pay it off right now. Well, what you don't understand is with the credit report, if you pay off a debt and you close that account, guess what happens to the credit?
You actually go down a little bit.
You do, because all that good payment history has now been erased. So
the good payment history, and also the length of credit, because that one goes off the boards that you could have had for a few years. Right. And your credit history will actually shrink a little bit. I have experienced that in paying things off. And whether it was credit cards or whatever, and my credit score went down.
Right. Yeah. So we can pay things off through the title company, right? It does not have to be paid off by you to qualify. You can omit those debts if you have the cash to pay them. Pay it off at title. Don't let your score go down. But, like as we're kind of talking about this, we also have back-end ways to manipulate the credit report to see if we were to pay it off, can we get a score improvement? So if you're talking with a lender that's not offering those services to you, I would recommend talking to somebody else, especially if you have some where you're not 100% sure if your credit score is good enough to qualify, or you just need a plan in place. Like, we have those capabilities.
Yep. For our first-time home buyers in general, what is the minimum credit score that they need to be at?
Are we using down payment assistance?
Let's go over a couple of different scenarios, because this is a question that I actually get asked quite a bit.
Okay.
And some people, some lenders will say 580, some are at 620, some are at 640 and 660. It just really depends. So I would love to hear from your perspective, as a general rule, like minimum requirements to get in.
So with the down payment assistance, I can go down to a 580, but I still have to get approved eligible findings. So, and those are, I have some private money funds that will do down to a 580. Now, if we're looking at like a T-Shack, TDHCA, those are all Texas down payment, state sponsored. You're looking at a 620. Those are all FHA loans. Now, if you want to look at a conventional down payment assistance, you're more in like a 660 range. So a lot of it depends on the product. But then you also have these little niches of grants versus bonds versus repayable versus forgivable. You have a lot of options. It just depends on the total profile, what one makes the most sense.
Yeah. So 580 with, and what do we do without any sort of down payment assistance? Because not all the first-time home buyers even qualify for that. Right. You would still say 580 for that?
You can go down to a 500, but those loans are brutal, right?
Well, I can't even imagine what the rate would be.
You're looking at a 45 to 60 day close, underwriting hot mess. So if you want something with a smooth process, 585.
Gotcha. And you do want a smooth process too, because very few things will wear you down like a rocky relationship with the processor. Let's just put it that way. I have a client who's using a builder lender, and the left hand doesn't know what the right hand is doing. And so you have them getting asked for documentation 2, 3, 4 times over. And it's frustrating to them, and it makes them think this person doesn't know what they're doing. And you don't want to give off that impression, but they're giving off that impression really strong right now. They told us earlier this week that closing was going to have to be moved a full week. And everybody was wondering why. Even the salesperson and the lender wasn't sure why. And they call and they find out, oh, that was the wrong address. We're still on for closing Friday. Awesome. You just gave my client an anxiety attack. Thank you.
Right. Well, that's because our business is relationship based, and it's not just transactional. So you have to think about when you're doing these things and setting deadlines, you're playing with people's emotions, because we know that in this 30 days that we're doing this real estate transaction, you are not yourself.
No,
you are not. And so there's
you don't have
grace.
Your base, your house, your home, like that is changing. And so what is typically your rock under your feet is more like sand. And then you have all these other external forces going on. That's why I try to make the deals as relaxing as possible.
Right.
I try to de-escalate as much as possible. I think, again, where being teachers kind of helps with that, because de-escalation was really our only option, and so you want to try and make it's never going to be stress-free. I'm sorry. I would love to tell people, oh, it's just, sign here and we'll be good to go. It's never going to be that. But certainly who you work with will define how much stress is involved.
Yeah. 100%. You have to have a team that's advocating for you. If you don't have that, then
your lender, that's such a good point. Your lender, you should feel like your lender is on your team, has your back, is working with you. And I have been in situations where it felt like the exact opposite, where once it was an escrow and the lender had them and it was in process, it was like the lender couldn't be bothered to answer questions, or the lender couldn't, just turned in, their personality changed after that, and never recommended them again. Giant red flags. But that is, you have to be able, you should always know that your agent is fiduciary and has to have your interest ahead of even their own. If you ever don't feel that way, then your agent is failing in one of the main ethical portions of that, and that your lender should absolutely be having your back in that situation. And ideally also your agent has a relationship, and so does the lender, with the title company, because title can actually be really useful in some of that stuff as well.
Oh, a good title company can make or break a client experience very easily. Because, so think about it, right? Travis, you have your realtor, that's your typically the first point of contact, then a lender, right?
Yep.
So think about just for an analogy, a fancy meal. You come in, you sit down, the realtor is your appetizer, everything's wonderful. Then your lender's your main course, everything's wonderful. And then your title company is your dessert. If that piece isn't good, what do people remember? They remember the bad.
Yep.
So really a strong team. And that's why we prefer to work with the people we know, like, and trust, because we do care about the experience. We want to make sure things go smoothly for you, and that you walking away, you're like, hey, that wasn't so bad.
Yeah, I know. And I've worked with quite a few title people. A lot of the escrow officers are super competent. I've worked with some bad ones as well. My personal favorite, I'm gonna go ahead and give her a shout out, is Amy Randall with Independence Title. I've done deals with her. So my very first real estate deal was done with her. I've used other titles since then. Came back to her. She's closed a house for me in 72 hours before.
Wow.
She is, and her assistant Song is so on point with everything that don't have to worry about that part. It's like working with you as a lender.
In Austin.
Yeah,
There's
exactly.
really great title companies.
Yes, and like I said, there's other ones out there. Don't get me wrong. If you're in title, you
We
watch
love you
this.
guys.
Yes, I love y'all and everything. But we have our people that we've worked with that we feel comfortable with that have delivered. I've never had a bad title experience with Amy at Independence, and we've done dozens of deals. So that's just my personal favorite. Just like you're my personal favorite lender.
Thank
And
you.
you're the person who I recommend to because, like I said, I like it to be stress-free. We worked on a deal last year together with that amazing young couple, and she told me at the end of it, she was like, this was so much less stressful than I ever thought it was going to be. And she just loved both of us from it. And of course, they were awesome to work with too.
They were fantastic, right?
Yeah. But
a lot of things, Travis, I think that to go back to teaching, we as educators had to have hard conversations. And when you shy away from hard conversations, the buildup just gets more.
Yeah.
Right? So if you can take a hard conversation and deliver it well with a solution-oriented mindset, it's not going to turn out as bad. It's when you're not answering your phone, when you're not available, when you avoid the conversation, when you
the issue doesn't go away. Like nothing is going to make it just disappear. So you're 100% right about that.
Well, I would just kind of like to finish up with saying, if you're a first-time home buyer and you have questions about what we've talked about today, we're available. Please reach out. We would love to be able to help your family establish this generational wealth building tool that we know it's legitimate. So if we can be of assistance to you, we would love to have a conversation about that.
Absolutely. Like I said, it's a passion for both of us. I love working with first-time home buyers for all the reasons that you just said. And in general, things go well and they're incredibly appreciative. They're so happy. They're the ones that are crying sometimes at the closing table because they're finally owning a house. And you're absolutely right. Once you get into that first house, then you're on the path to generational wealth. But you got to get that first house. You got to get off the rent wheel and you have to get on the ownership ladder.
100%. Well, if we can answer questions afterwards, feel free to drop us a DM or message us in the comments, and we'll for sure reach out promptly.
Absolutely. Well, thank you so much, Liz. We'll do this again next week, and y'all have a wonderful weekend.
Bye, guys.